listen-only mode.
Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 30, 2016. End of September, end of Q3. Well, for the quarter anyway, for the third quarter, U.S. stocks finished higher as they did on Friday, and it looks like it's posted the best quarterly gains here for the cash indexes since December 2015. All three of the U.S. benchmark indexes logged the strongest quarterly gains we've seen since DECE 2015. A lot of it is due to the Fed's not really wanting to raise interest rates and is putting more money into the equity market. We've got central bank accommodation globally. So we've seen the S&P finish Q3 up about 3.3%, and the Dow was up about 2.1%. And the NASDAQ just really blew through for Q3 at 9.7%. September was an interesting month. I've got on the screen here a 2-hour chart of the E-mini S&P 500 futures. Now let me just kind of clean the screen up here, take some things off the screen. So let me just do that for you. So it'll clear it up for you just a little bit. And I want to show you guys just the month of September. And if I were to draw that in here, let me just get it in here for you just so that you can see here. Well, let's just do it like this. How about we do it like this? Let's come over here like this, and we'll put in the month of September for the E-mini futures. And we'll put it right where it closed here for the month. Now, looking at this, you can quickly see that the markets started up in September. We had that huge sell-off going into 8th and 9th of September. A little bit of a scare the children. We came up, we came right back down and pretty much tested it. And then we've just been very choppy, as you can see. And then for the last 10 trading days, very interesting, we've gone up, we've gone down, up, down, up, down, up, down, and up. Very, very choppy going into the last week of September, or the last 10 days, two trading weeks of September, or last 10 days, I guess, 10 calendar days. It's been very crazy. And for those that are trying to directionally bias trades here, some of you probably got stopped out. I mean, this is a great position to be in here for credit spread traders that are out of the money, playing out of the money, you know, taking into account the potential pullbacks and the pop in volatility, primarily that we had over here with a pop in volatility. So we've seen the markets in September kind of work their magic a little bit from a vol perspective. Now, if we take this back off the screen again, and we just take a look at the last, let's say, 10 days here, you can see that with the activity on Friday, you know, we had the Deutsche Bank scare where, you know, there were rumors hitting the street that hedge funds were pulling some of their credit out of Deutsche Bank in Germany, on top of the Department of Justice, DOJ, here in the United States looking for $14 billion. Which I think was an absurd number, and it really drove the markets down, and it drove volatility up, and you could see this coming move like this. And then on Friday, about midday, reports started to surface that Deutsche Bank was going to be able to negotiate a better deal with the DOJ. I mean, it's not in the United States' interest to drive Deutsche Bank out of into a liquidity crisis and then cause problems worldwide. So I have a feeling they'll be more than willing to cut a deal with DB. And Merkel had come out, the Chancellor of Germany, and said they're not going to put any money into Deutsche, but they may provide liquidity and loans and get loan guarantees from DB. So she could save face by doing something like that. But anyway, all of that stuff pretty much reversed price action. And then we moved up into close into the end of Q3. And then we had a little bit of a sell-off of about 12 points. Some of this was due to some portfolio window dressing and then taking some profits and getting things going and then just putting it on the books and then selling it off again. But be that as it may, we come into the month of October, which is notoriously um, had been known for decades as a bear killer, meaning markets move up in October. However, in presidential election years, October has also been not a market that's not too kind to bullish traders. So, and we've got the U.S. presidential elections coming up here on November the 8th. So that's going to throw some uncertainty into the markets and keep vol a little bit higher than normal until we get through these elections. So it's going to be an interesting Q4. And I'd like to remind everybody that we've got earnings getting ready to crank up in the next couple of weeks. And as everybody does, all the analysts, corporations do it, they put on the back end side their rosy estimates and they keep downgrading and downgrading. Well, we've had 5 quarters in a row of an earnings recession, U.S. corporate earnings recessions, where year over year earnings have been falling. And if they continue that way in Q3, you're going to see the market stagnate or possibly fall. I've seen some comments out of some analysts that say the S&P is not going to go much higher than this from now to the end of the year. I've seen other analysts come out and say that it could go down a little bit. I've seen a few that say it could go up, but I don't see very many analysts that say that it's going to go up by 5% or let's say 3% plus in Q4, because in Q3 the S&P had a 3.3% gain. So let's see if that can happen, but I think it's going to be slim unless we get strong earnings. And we've also got the potential rate hike coming up in the December FOMC meeting. Now, they have another one on November 2nd, but nobody, including their brother, believes they're going to hike the rates 6 days before a U.S. presidential election. So most of the markets have discounted that and pushed it out to the December meeting where they're going to hike the rates. We're going to get some data coming up this week. We're going to get the ISM data on Monday, and then we've got a couple of the Federal Reserve folks talking. Every time they open their mouths, the markets do bounce around a little bit. And then we get factory orders the middle of the week. And then on Friday, we get the non-farm payrolls and employment numbers out of the U.S., along with a couple more Fed guys talking, or women talking. So it's going to be a really interesting week and set the tone. And I think all eyes are going to be focused on Deutsche Bank and news coming out of Europe. Monday's a holiday for Germany, as it is for China. So Monday could be a relatively quiet day, which may be good. It may give the markets time to settle in a little bit, but you can pretty well bet they're going to be focused on news coming out of Deutsche Bank and what's going on over there as a potential effect or a side effect of what can happen in the markets here. So looking at the E-minis, I'm going to put it back on the daily chart here for a second. You can see here, with the pullback and now trying to make it back up to these all-time highs, which is 21.92.26. I just don't believe that we're going to get back up there. If we do, it'll be because we're starting to get stronger earnings, more than expected earnings, and we've got a clear signal with Deutsche Bank. Okay, so we can have one of these kind of patterns that looks something like this, right? Now this is a ascending triangle, which means the odds favor a break to the upside on this particular pattern. Okay, and we could just kind of ride it, and then we can just wind up and then boom, go to the upside. I don't know right now if that would be my favorite choice. I'm not going to be making long commitments going into next week. If anything, I'm going to be neutral going into next week, and then I want the price action to make the move. To me, there are really 2 key areas that I'm watching next week. There's really 2 of them. And it's a little bit spaced out apart, about 91 points, and we can move around within this as evident this past week. But the all-time high is sitting at 21.50 or 21.91.50, and then the lows for the month of September of 2100. So that's kind of the range that I'm looking at for the month of October. I believe one of these areas is going to be broken. We could pop our heads up here and then come back in this area again. And we're clearly closer to that area, but there's a lot of uncertainty out there, from Deutsche Bank to the Fed's potential rate hike to the U.S. elections. And, you know, we've got richly valued equities. We've got earnings coming up in a couple of weeks, which I think are going to really drive some of the near-term direction in the markets. If you take out some of the existential threats like Deutsche Bank and the presidential elections, it's going to be all about earnings. So let's see how this thing shapes itself out, okay? I am still on record as saying in the next 12 to 16 months, roughly year to year and a half, 18 months, we're going to see anywhere from a 25% probably up to a 40% pullback in the S&P. But we've got some key levels that I've reviewed with my members that we're going to follow very closely. Really key levels that if we start breaking, we're going to shift our trading patterns to more of a bearish nature than a bullish nature. Right now we're very mildly bullish, neutral to slightly bullish going into this week, and I may shift my stance to more of just a plain neutral until we, you know, pick a side here in what we're going to do. This side right here, the only way that I would turn bullish for Q3 is I want to see better earnings coming out. We've already seen the market give us a tell in the Feds. If we get a 25 basis point rate hike, all right, if we get a 25 basis point rate hike, and that's it, a one and done for at least the next 6 months, which is what Aunt B, aka Janet Yellen, is suggesting, then the markets don't mind that. In fact, that's probably already priced into the markets. About 75% of it's already priced in. And mind you, by December of this year, there's only a 50% probability they're going to hike the rates by December, okay? Just 50%. Now, we're getting stronger data out. Like I said, this Friday, we're getting the September employment report out. Employment numbers, we're getting ISM data, and every time they come in at normal or slightly above normal, that puts more pressure on the Fed, and you'll see the probability of a rate hike going up for December. So even if they do hike the rates 25 basis points, but Aunt B, aka Janet Yellen, says it's kind of a one and done, and we're going to sit back and wait till probably, you know, she's not going to give a time frame, but the markets will interpret that as a one and done. We're going to go higher, because if you couple strong earnings with that kind of signal, we're going to go higher. Okay, because there's still no place else for the money to go. And if you think about a 25 basis point rate hike in an already almost zero interest rate environment here in the U.S. and sub-zero negative rates in a good part of other countries all over the world, from China to Europe, then it's almost inconsequential, that rate hike, because there's almost no inflation out there, and the markets are just, you know, just grudging along in 4 feet thick muck. That's kind of where we are right now. So the markets are going to grind higher. If we get other Fed governors come out and say we can see more than one rate hike, then that's going to add a little bit of a bearish bias to the markets, and we're going to see the markets come down a little bit to get the PE ratios a little bit more in alignment. And again, we've got to factor this in with the earnings that are coming out. Now, keep in mind, you don't have to keep track of all this. All you got to do is follow key price action and take a look at these key pivots going into this next week, 2191.50 and 2100.25. I'm going to follow these very closely. Inside here, the markets can come down in that area very easy. Keep in mind also that the 200 EMA is sitting at 2088 with a slight upward trajectory. The 50 EMA is flat. I mean, just dead on flat, like a runway, airport runway. So that says going into October, we're relatively neutral on the market, okay? Relatively neutral. And it can go either way. And it's kind of, if you think about it, price action has kind of set itself up this way. After the fun and games in the last week of Q3 with portfolio rebalancing and all the rolls, and all the things that you typically get at the end of a quarter. Now we're coming into October, and it's kind of be start fresh again. So you've seen price action kind of over the past week pretty much stay relatively neutral. That's where we are, folks, and that's kind of how it sits. Now, if I put all of my indicators back on the screen, you'll see I've got all of this highlighted here, and this colored bar I've had on my screen. For those of you that watch my weekly updates and roundups, you'll know that I've had this colored bar on the screen since we came off the Brexit lows here, here back in June 27, when we got down to 1981 area, and then boom, we just screamed up. I mean, it was a big move, and off we went to the races, and we hit. The timing was perfect, and this is going to continue to be a huge overhead bar for us, or huge hurdle for us to overcome up here. The only way we can move higher than the 2220, 2250 area, we got to have strong earnings. We got to have an accommodative Fed. Okay, we have those two together, and the markets continue to, or the economic data continue to show progression. Then we're going to continue this grind higher, and then we will make it up there. But I do believe we're setting ourselves up for a major pullback. If we go through March without a 20% pullback, which I believe we will have, it'll be the longest bull market on record. Remember, a bull market is defined as not having a 20% pullback. A correction is a 10% pullback, but it doesn't officially make it a bear market until you have an official 20% pullback. And none of these pullbacks over here were 20%. So that's kind of where we're sitting right now, guys, on the S&P 500. The other thing I wanted to show you here was NASDAQ. If we take a look at it, I got to find it here. Just bear with me 1 minute. Where'd it go? Interesting. Let me just find it. Well, that's really interesting. If we look at well, let's look at this here for a second. Let's take a look at the oil market. That's another one that we're following here. If we take a look at oil, you can see here in oil how we've come off of these lows, and now we're sitting in one of these kind of patterns like this. It is like that, and we're slowly we peaked our head above right here. Now remember, we approached this symmetrical triangle from the downside up, so that would suggest an upside breakout, which we're getting, which would put us at a peak here of 52. Now the measuring objective of this would be the distance of this right here, which takes us from 38 to 52. So that would give us about 14 points roughly, which would take us up into this area here. I don't believe we're going to get it. I do believe that I think 52 is going to be an overhead resistance, a strong overhead resistance to us for oil going into the end of Q4. We've got OPEC meeting this coming week, so we've got to, I'm sorry, they've had an informal meeting. They've informally agreed for the need to reduce production. I mean, that's what they said, the need to reduce production, which is really funny, I think. They don't meet till the end of November. So oil, I think, will kind of grind and stay in a wider range, but probably not take out key pivot areas unless there's some existential news from OPEC. Otherwise, we're going to stay in this area. If we get up in this area here, and then we go into the OPEC meeting the end of November, it could give us a bump up here if they do agree to a production freeze. But keep in mind, the higher it goes, the more you're going to see shorts come in and push it back down. I don't see oil getting up much more than, say, $60 to $63 a barrel in 2017. They've got so much excess inventory to work off that I just really don't see that happening. I think it'll be very tough. The other thing that we've got here is in the currency market. We're looking at the Japanese yen. You can see here that the Bank of Japan has just had a hell of a time trying to keep the yen down. You can see where we're sitting right here now, but they've had a hell of a time trying to keep this thing in place. And I believe that, I've been saying all the way back here in the summer months, selling calls against the Japanese yen, or FXY, which is the ETF that is the tracking ETF for the yen, makes a lot of sense to me. And these are some trades that we're doing. And by the way, in the oil market, we're doing some short ratio strangles in the futures market there. We look to profit from those over the next 3 weeks also. So these are just some of the ones that we're watching very closely. The other one that we're watching is the bond market. As you can see in the bond market, we just, and I was saying this, that it's been a very stealth move down, very stealth. Even though we've been going down, you've had these huge rallies that we go up to the top of the channel, right? And it goes all the way back up to the top. Then we came all the way down, but then again, we went back up to the top of the channel and it's holding. And I'm saying to our members that when you get up to the top, the odds favor entering shorts in the bond market. And it makes sense. Now, every one of these is coming down. So that would suggest as the 200 EMA pretty much flattens, a move back down into this area here, which is around 166. Now the bond market closed at 168. And it can stay choppy in this area, but I believe the break is more favorable to the downside than to the upside. So we're looking at this very closely, but the bond market has been fun, going all the way back to the July timeframe. In trading this move here, you can see we're well off the 2016 highs of 177.11, and we've hit this channel, and this the upper boundary of the channel has been a huge resistance point for oil, as you can see as I've circled here on the move down. And now we hit it again just a couple of days ago on Thursday, and now we're backing back off of it again. So I believe, I always like to follow a pattern until the pattern doesn't work anymore, because the odds favor the pattern to work basically until it doesn't work anymore. So, up in this area here, you can put on shorts and have buy stops a little bit closer to market. And the odds favor a rollback over again, which is what we've seen. So that's a little bit about where we're sitting there in that market, I believe. Now, if we come over and look at nat gas, the natural gas market, which is really interesting, we're coming into the winter months with natural gas. And you can see here that, we made a high and we made a higher high up here with nat gas, but it also gives us that, very familiar 3, 4, 5 pattern, right? When you get a 3, 4, 5 pattern, you have a high here and it's taken out with a new high up here. Okay, as we did. It sets us up for what we call a bed or a bearish divergence in the MACDs, which says the odds favor a little bit of a pullback. I would think at least to the 50 EMA at roughly 2.816. Okay, now this is nat gas futures. If we have a very cold winter, and we're in the seasonal period here for natural gas. Coming into September and October, it's seasonally strong for nat gas. As you can see, ever since towards the end of June or end of May going into June, nat gas has just been on fire like that. Okay, so I want to look for a break here. If we break this trend line, we're going to come down and hit that major pivot, which is just south of 2.7. Selling calls up here in the nat gas market makes some sense because we're overextended a little bit and we got this divergence down here. So I say a little bit of a selling in is going to be in order. So these are just some of the things that we're looking at and that we're playing. The other one that I really like, guys, is orange juice. Orange juice hit a 2016 high up here, and if I put it on a weekly chart and I really take it back out in time, this is a commodity. And understand how commodities work. You have supply imbalances, you have inventory, you have supply and demand, and it works differently for commodities than it does for equities, of course. In the commodity market, if you've got a lot of demand and limited supply, the price goes through the roof. And then farmers or producers or growers, to meet that demand, will oversupply or overcommit to the next crop season. And then they will create more supply, and then the supply will grow, and then that will drive the prices down, because then demand starts to fall when you've got these high prices. And you can see here we're almost at all-time highs, at least going back to the early 2000s for OJ. We hit one time in the week of in January in 2012, and then back in 2007 in January as well. So going into the end of the year suggests that, you know, we could possibly have a little bit of a pullback and then one final capitulation a little bit higher, and then we're done. And the nice thing about OJ is that when it gives it up, guys, it gives it up real quick, right? I mean, it just falls right off the table, and there is no ifs, ands, or buts about it. Now, you can't time this thing. It is and I admit the risk is a little bit higher by entering shorts up here, but the odds favor you in making a play to the downside. Again, you got to have very wide stops because you get very choppy at these peaks. Now, if you're a more conservative investor, what you can do is you can come in here on a daily chart, and you can look at the daily chart here, and then you can just look and see, you know, how it just overextended itself here, and it's back down into this area here. And you can say, if I've got a cross, now I use a very tight 412 EMA. If I got a cross in the 412 to the downside, I'm already short OJ, but I would look at possibly, you know, adding to my shorts in this kind of environment right here. So we've got this overextension in orange juice. The other one that's really interesting to me is sugar. Sugar is another overextension to the upside. There is a huge abundance and supply of sugar worldwide. Now, if I go way back out in time here, you can see that sugar back in 1974, we had a really runaway wild market, and sugar got up to $65. It was crazy. But we're here, if we look at a more normalized environment, that shows you sugar does run, and it runs both up and down. It's a little bit more volatile, believe it or not, than orange juice once it starts running. You can see sugar in this market, we're right in this area here. So it can go higher up here. So the odds to me tell me that it can go higher. Now it may not, it may just roll over, but it can go higher. The odds are, you know, long, short, 50-50 on this thing, even though it's extremely overcommitted here to the upside. Not like orange juice where we're hitting all-time highs in OJ. So if we look at this thing, and we put it on the daily chart just as we did orange juice, you can see right here we've got this 3, 4, 5 pattern, but the big difference here in this, which tells me it could go higher, right? Here's the 3, here's the 4, here's the 5 pattern. Typically on a 5 leg, right? Typically on this 5 leg right here, I want to see bearish divergence. There is no bearish divergence. If you look at that, it's almost a straight line. You know, it's an airport runway. So that says there's just as much strength going into this as there was in the initial uptick. So similar strength tells me any pullback here is probably going to be bought, and it's going to drive it up and surpass the 2016 high price so far. So I'm going to stay away from this. But OJ, I like that more to the downside. Now understand, we're going into hurricane season. There's a Cat 5. I think I saw that in the news this morning. It doesn't look like it's going to hit Florida, but if it does, it's going to decimate the orange juice crops there, and it's going to drive OJ up even higher. So there is some risk to the trade. For those of you that can trade options on orange juice, you know, probably shorting orange juice in the futures market and then buying a call to create a synthetic put would be probably the ideal way to play OJ, because you limit your upside risk and you maximize downside return should it really fall off the table. All right, everybody, that's just a kind of a quick and dirty of where we are right now and just my opinion on the market. For our members, I will see you Sunday night. Otherwise, everybody have a really great weekend. And if you're not a member, I highly encourage you to come in. We've got a lot of members worldwide coming in and loving what we do. So I will see you guys later, members, Sunday night. Have a good one, everybody. Ciao.